Here to discuss is co-founder of 314 Research, Warren Pies. Warren, good to see you. What's a Goldilocks environment in the current moment? I know it's not too hot, not too cold, but how would you characterize what we're looking at in terms of the macro backdrop?
Yeah, great to be with you again. For me, Goldilocks is the ideal place for the equity market, and that means that we have cyclical disinflation, and those tailwinds are with us. It's almost automatic when you look out at the economy on a cyclical basis that we're going to have shelter disinflating, we're going to have oil cooperating in our view, and you have a labor market that's weakening. And I think it's weakened on a cyclical basis, but also potentially more on a longer term structural basis with AI. And so that alleviates some of the Fed's Philip curve concerns about inflation. So you have that. But on the other hand, we are going to get this fiscal expansion, in our view, during the first part of this year. And that's starting to be reflected in earnings guidance and things like that. So one big, beautiful bill will kick in. You have tax rebates, you have bonus depreciation. And ultimately, the net is just like close to a 1%, 100 basis points of fiscal expansion, which is significant. And so when I put those two factors together, that's a very good backdrop. And then you add in rate cuts, and you add in the fact that the Fed says, yes, the economy is going to grow, unemployment rate will be steady, and we're still going to cut the rates multiple times this year. I don't know. It's a pretty great backdrop for equities in our view.
Yeah, I guess, I mean, where would there be any offsets or where would the market start to move in a direction that would suggest either going to be too hot or, you know, we're not going to get as much Fed as we thought? Or how do you think it might diverge from that if you had to do the scenario analysis?
Yeah, our best guess is that the main risk towards the market come from an overheating, and that would be towards the at least second half of the year, and probably even later than that, in my view. Of course, there's always the risk that the economy the labor market could crack or something like that. But again, we just had an employment report, and it was very Goldilocks, not to overuse the term. So my best guess is that once we get through into the second half of this year, the reheating could start to bring into view the end of the Fed's cut cycle, and I think that's where. There's been a lot of premature concerns around rates in the bond market, but that's where I think that a true curve steepening could start to take hold more than what we've seen. You know, something where the twos versus tens gets well over 100 basis points as the market starts thinking about the next move being not a cut, but maybe a hike. And that's late this year in our view at best, but that's the catalyst for risk that we're seeing.
And so for the first half of the year, when you do think there's a pretty clear path ahead in terms of the cyclical upturn and friendly Fed, is it as simple as, you know, own more cyclical parts of the market, or is there another way to play it?
I think this is going to be a broader year than we've seen over the last three. The last 3 years have been three of the most narrow years over the last the seven most narrow years going back to 1960 by fewest constituents beating the index. The beginning of this year, we've had 311 stocks beating the index. That's a crazy high breadth from that perspective. And you've seen Mag 7 underperform. I don't think that that's sustainable. Given our view for the market, I think that tech's going to reassert its leadership, and then you're going to have these non-tech AI beneficiaries and a little bit of cyclicality start to come along for a ride. So it will be broader this year, but not as broad as we've seen at the beginning of the first half of January. And I don't even think that's very healthy for the market, to be honest. That amount of that kind of leadership. So I think it's big tech. I think Mag 7 breaks out from this consolidation and reasserts some form of leadership.